Ladies and gentlemen, a warm welcome to you all. My name is Stefan van Wolderen. I've been running the research part of the Think Forward initiative since 2016. Only able to do so thanks to the help of many others, including 2 other research board members, one of whom you all know, or almost all of you know, Michael Haliassos. He will be here tomorrow. And the other one is Ian Bright, he's in the audience. I want to tell you that I'm absolutely delighted to be here at a CPR event and double delighted to be at a TFI CPR event. Before I hand over to Stefania Albanese to chair the rest of the meeting, I'd like to give you a brief update what the TFI has achieved last year, where we stand currently, and what can be expected in the next few months, so that you have a bit of an idea. So what was achieved in 2018? It was quite a special year, I must say. We were able to organize 2 calls for research proposals, which resulted in many proposals being sent and peer-reviewed. And 16 short-term projects and 12 long-term projects. For several of those, the ING Data Protection Board Netherlands agreed to give access to ING customer data, aggregated data in the Netherlands, in a way that respects GDPR and puts the interest of the customers first. All is done with a clear, for research-only intention. So let me show you one slide. That's my only slide for this presentation. So this is the so-called heat map, and it shows a bit where we stand with the research. So TFI wants to have a fuller picture of human financial decisions for individuals in their social and macro context. So that's what you're looking at. You see column-wise, you see spending and budgeting, borrowing, saving, investing, pensions, planning, and insurance. It's all clear to you. At the bottom, you see the individual level. In the middle, the social level. And at the top, the macro level. So the darker the heat map in certain areas, the more projects are covered within the initiative. It should, by the way, be noted that a dark area doesn't always indicate that we know already or have even the want to make the suggestion that we know already everything about that topic area. It's just it could also indicate that it's a very complex area or important. So for some areas you need to do more projects, perhaps. So 2018 has helped tremendously to make progress in covering more areas, and still there are some white or light spots, and we're not intending to fill the macro part per se, but the social and the individual part, there are some areas there. For example, related to privacy, identity and profile, which is related to that, data use and ownership, location, vicinity, things such as gender, education, socioeconomic background. So these are all sub-themes relevant to the individual that we think should be more research, that we know too little about to fully understand the individual in its social and macro context. So in case you have any suggestions, which topics should be considered by TFI for a next round of proposals, please let me know so that we can have a conversation about that and that we can take that better into account next time. So what can be expected for the next few months? Let me start very generally here. First, the current partners, so CPR, ING, but also Deloitte, Dimension Data, Dell EMC, and Amazon Web Services, will continue the search for more partners. Because with more partners, we are able to do more, of course. And yeah, financial decision making is still an important area. There are many people in all over the world that are struggling. So we need to research more in some cases, and this heat map also indicates that. Second, it is likely that TFI will have the status of a foundation this calendar year, so that's planned. We think it would provide a clearer formal structure to give and receive insights and data for practical purposes to startups, scale-ups, NGOs and others, as long as they have the intention to help people make better decisions, better financial decisions. Third, this year we will further improve on clearly matching our efforts in the Research Hub and those in the Innovation Hub. So that's the third thing I wanted to share with you. And if you're interested to not only do research, but maybe to do something on the practical side, so working on solutions, that's a possibility. We already see that happening in some of the short-term projects. If we have time during these years, then we can talk about that. I'll give you a few examples. And lastly, on the research side, we're planning to launch a new round of proposals late June. So that's the date where we plan to do a next round. So again, if you have any suggestions for topics that you think should be covered in that round, let me know. So thank you again, warm welcome. Hope this will be a very interesting discussion. I hand it over to you, Stefania. Thank you.
Thank you, Stefan, for the introduction. Let me see if I can. Oops. Okay, let's start. So thank you all for attending this session. So we decided to, as a theme of the session, to discuss fairness in consumer credit markets. So fairness, I'm going to talk a little bit about how we think about fairness, both in economics and in computer science, which has been thinking a lot about this issue. But the reason that we chose this theme, obviously, it's very, I think, connected to the mission of the Think Forward initiative. And it's also something that's been very highly discussed in the United States and in Europe in terms of the development on consumer credit markets, but also more in general on with the rise of big data, AI, and machine learning. So that's going to be, where we are headed with the discussion. The session is going to be organized as follows. So we're going to give some short presentations about this theme, and we are very happy to be joined by our three distinguished speakers, who are Chuck Robida from Experian, Jan Dodion from ING, and Brian Bax from the Consumer Financial Bureau. So Chuck Robida has been at Experian for about 15 years, and 25 years, I'm sorry, I missed 10 years. And he's a chief data scientist, and he's been responsible for the development of VantageScore and other credit scoring products that Experian has been developing, and that I also use in my research and in my data. And he's joining us from Atlanta. Jan Dodion is head of credit analytics at ING, and so he's going to give us a European perspective on this question. And Brian Bax is at the Consumer Financial Protection Bureau, and he's going to give us very valuable policy insight and also practitioners' insight as to how these themes are tackled from the standpoint of a regulatory agency. And we're going to have short presentations and then a structured panel discussion, and then there's going to be an open panel discussion. So we really hope that you can participate and ask questions in that time. So without further ado, I think we should get started. Yeah.
Perhaps we could all move down there so that we can actually see the presentation, because otherwise it's right behind us, and then we can see each other's presentations. That'll make for a better panel discussion.
That would be fine,
Is
as
that
far
all
as
right?
I'm concerned, yes.
Okay, all right, let's do that. Absolutely, to do our own presentations and then come up with a discussion. Okay. Great.
And before I move on, I should also introduce Tarun Ramandorai, last but not least, who was really critical and also putting together, the theme and the discussion on this topic. So let me begin with just a very brief discussion of, how I think economics has started to think about fairness. So first of all, the premise of this whole event is that there's been a strong growth in consumer credit markets. And so a key question in that sphere is how credit is allocated. And, economic models, but also I think in practice, perceived default risk is a key determinant in terms of who gets credit, how much credit they get, and what the conditions of credit, interest rates, credit limits, and so on. And the question is then, how is this credit risk calculated? So in the US, we have a very well-established system of credit scoring based on information from credit registries that are compiled by the 3 credit bureaus, of which Experian is one of them. In Europe, it's more of a mixed situation. So most credit registries are in fact held by governments. And one feature of European credit registries is that in fact most registries only contain negative information, meaning for loans that are not too large, these loans would be reported only if they are delinquent. So financial institutions in Europe, often rely on internal model and their own customer data to compute and calculate credit scores or estimates of credit risk that they potentially use to allocate credit. Now, the trend, both in the US and in Europe, is to use ever more data. And what I mean by this is both user-supplied data or user-solicited data. And Chuck is going to talk a little bit about this in terms of what Experian is doing with some of their product. But also data that the user doesn't necessarily know is being supplied, like behavior on credit applications. So how much time you spend, typing your name or, on the income, tab of the credit application. And also, increasingly, we're using better, in quotes, prediction technology, particularly machine learning techniques and AI and other methods that are demonstrably better at prediction in most contexts. So this raises some very important questions. First of all, which I hope we'll be able to discuss in the session. The first obvious question is, do better data and technologies in fact improve the allocation of credit, or are there any pitfalls attached with using these better technologies? And then the second question is, who is left out of credit markets? What are the consequences? Why? And is this related to this greater use of data and technology? And then more in general, can we reduce default risk both at an individual level and at an aggregate level, while at the same time, increasing access to credit to people who, are needed for a variety of reasons. So these are going to be the themes that we're going to discuss in this session. So because the title of the session is Fairness, how do we think about fairness? And I think here, there's a little bit of debate. So the computer science literature that has been thinking a lot in the last, I would say, 5 or 6 years about algorithmic fairness has, some algorithmic notions. So the first one is anti-classification. So the idea is not to use attributes that are protected either by law or because we think that they should not be used, such as race, gender, religion, marital status, age, and so on. And in the US, this anti-classification principle is in fact legalized and it's coded into legislation. The second algorithmic notion is that of classification parity. So with respect to specifically credit score, the idea is that the predicted performance should be equal across groups, conditional on observables, such as income and other observables that might matter for default probability. And the last criterion, which is the hardest one to implement and to think about, is that the outcomes that are generated by the models that we use to rank consumers by their perceived default probability should be independent of these protected attributes. So we shouldn't see outcomes be overly dependent on race, gender, and other attributes that we think are important and are protected. Now, our economic notions of fairness or equal access to credit, to some degree all fall under the rubric of calibration. So, the outcomes that we care as economists and, that we think ought to be fair in this sense are access to credit, the price of credit, but also sort of at a deeper level, access to information, including, the ability to understand different types of credit products and how credit is allocated and how credit scoring models work, and transparency with respect to the processes that give rise to the production of these credit scores, but also the criteria that then lenders use to allocate credit conditional on the scores. So these kind of economic notions are all outcomes that we can sort of think about under the notion of calibration. So we think that these outcomes potentially ought to be independent from the attributes that are protected. Now, I'm going to talk a little bit about the US system because the system is more codified and obviously most people here already know what it looks like. So credit scores are really key in the United States credit scores and credit reporting in the United States started in the 1800s. So there's a very long history of that. And with respect to anti-classification, as I said earlier, it's mandated by law, and the two key pieces of legislation are the Fair Credit Reporting Act and the Equal Credit Opportunity Act. So these laws, mandate what kind of information you can use in credit scoring models and what kind of information can be reported in credit registries and credit reports, and are really the key for, or a key stepping stone for, guaranteeing or trying to guarantee, fairness in the U.S. system. With respect to classification parity, we don't have a lot of public information as to whether the credit scoring models that are used by FICO or by the credit bureaus, in fact, satisfy classification parity. And so this is an area where I think, economic research can make some progress to sort of, improve our understanding of what is going on. With respect to calibration, actually, both in the media and in academic research, we have a large body of evidence that suggests that certain outcomes are very unequal across protected groups. With the HMDA data, which is this mortgage data that we have for the US, for which we have the race of the borrower, lots of people have found disparities in terms of how lenders, approve mortgage applications for borrowers of different race that look quite similar to each other. This is just in terms of access to credit, but also in terms of interest rates and types of products and financial literacy. There's a lot of evidence that outcomes vary disproportionately across different types of groups, even conditional on observable characteristics that would matter. And also in general in the United States, there's definitely a sense of low transparency. So most consumers don't quite know how the system works. And it's hard, for some consumers to find information. And this is despite the fact that there's a lot of legally mandated disclosure requirements that lenders have to subscribe to and also credit bureaus have to subscribe to. Now, I'm going to talk a little bit about the fact that, often these unequal outcomes are justified based on credit scores. So the idea is that lenders will say, well, we don't allocate credit to particular types of borrowers because their credit score is low. And, so this is a justification. Credit score is associated with higher probability of default. But there's 2 or maybe 3, potential concerns with this kind of view. The first one is that credit scoring models use features or covariates that are in credit reports that may be historically biased because, some groups have been excluded by certain credit markets. So obviously, again, in the United States, mortgage market is a big one because of redlining and historical, segregation of housing. Many black borrowers have been excluded from the mortgage market and the housing market, and that could affect their credit score and also other covariates with respect to their access to credit. The second pitfall, which I think is probably harder to think about, is that there can be a self-confirming cycle of low credit score, costly credit, and high default rates, meaning if all other things equal, I only have access to a more expensive credit product, say a credit card with a higher interest rate, I'm more likely to miss payments because given the same negative income shock, if I have a higher monthly payment on my card, I'm more likely not to be able to make that payment, and then it's going to look like it was the low credit score was correctly predicting that I have a high default probability, but in practice, I'm sort of trapped in this situation. So this is, statistical discrimination, if you want to think about it, or it could be a manifestation of statistical discrimination in credit markets. And the last, issue with the credit scoring system in the United States is that there are a lot of unscored consumers. And this is actually a concern on part of the credit bureaus as well as the government, I think, and regulatory agency. So why are there a lot of unscored consumers? So the official, if you want, criteria for not giving a score to a consumer is that the consumer doesn't show any updates or report on their credit file in the past 6 months, or doesn't have any accounts that are more than 6 months old. So obviously, the young tend to be, highly represented in the unscored, but also low-income households are highly represented in the unscored. And again, this could be a feature of a trap. If I have low income and I don't have access to credit, I am unscored, and therefore I also, it's another reason why I don't have access to credit. But if you look at the racial composition of the unscored, so this is some data from a paper with my graduate student that we are working on. So you can see that the highest fraction of unscored is in the areas by zip codes that have the highest share of minority representation. And this is just for Black and Hispanic, but it holds more general for more minorities. So then going back to the issue of fairness and inclusion, not having a score essentially limits access to credit for the people who are unscored, which tend to be disproportionately minority, and that is a protected attribute in the United States. But also, if you look at a population that has a high fraction of an unscored consumer, the credit score for that population may be inaccurate and may also impair assessment of fairness. So if I look at the distribution of scores for a population that has a high fraction of unscored, it can give me a different sense of what the distribution of risk is for that population, as opposed to with a credit score that scores everyone in that population when I compare it, say, to white borrowers who tend to be more scored. And then, we also have the sense that financial literacy is very low amongst minority borrowers. That may be a reason why they are not accessing the credit market, which makes them unscored. But then the fact that they are unscored prevents them from accessing the credit market and gives them little incentive to become financially literate. So we have another situation where we have a trap along these lines. So to conclude, credit scores are really key in enhancing fairness. So a lot of the discussion is about how do we think about credit scores, and though the credit scoring system doesn't apply as such in Europe, there is still a need to score consumers with respect to the probability of default. And as the consumer credit market expands in Europe, obviously these concerns are going to be more prevalent there as well. So I'm going to turn it over to Tarun.
Okay, well, thanks very much, Stefania, for putting this panel together, and thanks to to all the panelists for coming as well. I'm looking forward to the discussion. I wanted to spend just a few minutes talking about a little bit of my own work in the area, because I thought that might be a good and efficient way for me to sell my work to all of you, a captive audience who can't go anywhere. But hopefully it'll cover some of the themes that Stefania talked about. This is joint work with Andreas Fuster, who's now at the Swiss National Bank, Paul Goldsmith-Pinkham, who is now at Yale SOM and was formerly at the Federal Reserve Bank, so was Andreas, and my colleague Ansgar Walter, who's also at Imperial College. So the usual disclaimer applies that it doesn't express anybody's opinion other than ours. And so I thought I'd start with a little bit of a picture. So before I kind of get into the picture, one of the things I should just point out is that this debate about algorithms and whether they are going to enter and make the world a far better place, or enter and the robots will take over and we'll all be doomed, is kind of one that's been going on for some time now. It's concerns that we have in credit markets are just evidence of a particular area in which these broader concerns are manifesting themselves in financial markets. And in some sense, they're kind of on the front lines of the issue, because finance is a big user of technology. So people are naturally worried about what the impacts are going to be. Now, of course, thinking about these things is difficult. So what we set out to do initially is to just set up a very, very simple framework to try and understand what possible impacts there could be, and in particular to see whether the dystopian predictions might actually come true. So this is our sort of attempt at coming up with something very, very simple, which is we're thinking about a lender who's trying to make a decision about a particular type of borrower. The borrower has a single characteristic, which is X along the X-axis. You can think about that as income. Along the Y-axis, this is the default probability of the borrower that we're trying to estimate. And think about a primitive world in which people have access only to simple linear functions that they can fit of X to try and predict what the probability of default is going to be. In that world, you're only going to be able to fit lines that look like the red dashed line in the picture over there. And so what you will get is, obviously as income increases, predicted default probability decreases, and so that's what you might see. Okay, now this is by no means what you will see. This is just one possible manifestation of being able to fit linear functions. Now, into this world comes what we think of as being machine learning technology, which in our particular setup is just a fancy way to fit nonlinear functions. And we've given you a particularly fancy nonlinear function, which is a convex quadratic. This is, again, just an example. It by no means needs to be that this is the relationship. And we're not even thinking about the endogenous distribution of interest rates or any of that kind, or the generation of interest rates or any of that kind of stuff, or default and how it changes with interest rates. But we will later in the paper. So what happens when this new technology enters into this world? Well, people who have characteristics X, where the blue line is below the red dashed line, are in this world going to benefit by the introduction of new technology, because obviously what will happen is their predicted default probability falls, whereas people who are in the tails of the distribution of X on the left and on the right are actually going to suffer because their predicted default probability rises relative to the linear case. Obviously, if we had a concave function, the opposite results would apply, but this is just for illustrative purposes. So why might we be worried about something like this? Well, if we had particular ethnic groups, racial groups, genders, ages that had different distributions of characteristics, then generically speaking, the introduction of the new technology doesn't make all people better off. In a world in which, for example, the red group had a tightly distributed X variable, and the blue group had a very loosely, diffusely distributed X variable, then you would notice that when the new technology came in, the blue group would get penalized. There are more losers in the blue group generically than there are in the red group. And so if the blue group were in fact blacks and Hispanics or any other protected group, or people that you might care about, particularly from a social welfare function perspective, then this is troublesome. Now, is this discrimination? Is this a lack of fairness? No, not necessarily. This is just distributional consequences of the fact that new technology has come in. So we haven't really gotten into the notion of whether this algorithm is fair or it isn't, but it does make the general point that algorithms do have distributional consequences, and we might be worried about those from a political economy perspective. However, there is a case in which this could be worse in terms of an algorithmic fairness type of issue. Because the previous example could have just arise from the fact that the new technology fits the distribution of characteristics X better, or maps the characteristics X to the default outcomes better. But there's nothing per se, unfair about this. But it could be unfair if the alternative was that your group membership in the blue or red group, and this was the actual true model that was out there, which is that, in fact, the predicted default probability should just be a linear function of the characteristics X, but also a function of your racial group. And if that is the case and you're only allowed to fit linear functions, you don't get a problem, but you do generically get a problem when you're fitting nonlinear functions. And so to illustrate that, let me show you a sort of slightly different graph. And so in this particular graph, you have two groups, the blue group whose true default probability line is the solid blue line, and the red group whose true default probability line is the lower red line. Now, the linear function is only going to be able to fit something that's in between those two things. In this case, if the groups are distributed 50-50, then you'll sort of get something that lies somewhere in the middle of those two things. But of course, it'll be either closer to one or closer to the other, depending on the ratios of people in the population. But a nonlinear function is actually going to push you towards the tails and curve you upwards towards the blue line, because it knows that the mass of the blue people in the corners of the distribution are greater, and so it's going to basically bow the shape of the curve. And so you'll get essentially what's called triangulation, which is to say that the algorithm is trying to back out from the distribution of characteristics, whether you're black or blue or red, and actually figure out what default probability to give you. And this, in terms of the current credit policy, is illegal in the US, in the sense that it is true that the inputs are non-discriminatory, but the use of the technology in some sense violates the spirit of the law, while not necessarily violating the letter of the law. Now, of course, this will manifest itself in outcomes, and so you could check outcomes, but it is rarely, if ever, the case that these outcome-related measures can be proven decisively in court to be evidence of a problem, and so people often look at inputs. Okay, so this is all sort of theory. It turns out it gets much more complicated and nonlinear when you have non-differentiable functions, and it's and very complicated multivariate distributions. So and plus multiple X characteristics. So what we do is we need to go to the data. We can do some things in closed form with simple theory of this nature, but what we really need to do is to go to the data to see whether this is actually an issue. So what we do is we go to the Fed, and inside the Fed they have the HMDA data, which has race, ethnicity, and gender of mortgage applicants in addition to a few different attributes of their applications. And then they marry it internally in the Fed to the Black Knight data, which has the default status and loan performance status of these loans, in addition to a number of different mortgage characteristics. So the linked data set that we work with is close to 10 million mortgage loans originated between 2009 and 2013, but we track their 3-year default performance out to 2016. These are both portfolio and GSE loans, and then we define default as being 90+ days delinquent within 3 years of origination. What do we do with this data? We basically just fit both standard logit and multivariate logit and binned logit models to the data, which we think of as being sort of closer to the current technology. We would consider that linear because logit functions have linear decision boundaries or planar decision boundaries in X space. But we also then fit a random forest model and various other tree models to the data to see what the comparison looks like. And when we do, we come up with this picture, which I will just take a second to illustrate what actually comes out of this. This is, obviously this is using loans that have already been originated, but this is like saying, look, if any lender were to use the historical data and run either machine learning models or standard logit style models with the data, what would they come up with in terms of different racial groups? So this is a cumulative distribution function. And what it shows on the x-axis is the percentage difference between the probability of default estimated from the machine learning model and the probability of default estimated from the logit model. So how do I think about this? I think about this as those on the left-hand side of 0 are those for whom the machine learning model gives you a lower predicted default probability than the logit model, and those to the right-hand side of 0 are those for whom the linear breed logit model gives you a lower probability of default than the random forest. Okay, so people on the left are kind of winners because of the new technology, and people on the right are losers because of the new technology. And so ideally, you'd like to see this distribution across racial groups. The good news to begin with is all racial groups seem to generally either win about the same amount as they lose or win more than they lose by the introduction of the new technology, suggesting that on the extensive margin, this is not likely to be a problem. The big issue here is that the differential impact of the technology is substantially worse for white, Hispanic, and black applicants than it is for Asian and white applicants. And so what you see is that Asian and white applicants disproportionately gain from the introduction of the new technology, whereas black and Hispanic applicants don't gain quite as much. So if you like, the diff in diff is D-technology, D-race is bad for minorities, essentially, okay? Is what this is showing, and then we bake it into an equilibrium model and so on and so forth to sort of give you some more predictions, and we try and do some counterfactuals, even though we're working with data that we can't actually see. Okay, so if you decompose the model improvements and you check whether it's flexibility or triangulation, it turns out that it's pretty much all of it coming from the fact that the technology is just better able to fit the X distribution to the Y distribution, essentially, rather than trying to get race through the back door, as it were. So that's good news. About 6 to, a maximum of 8%, minimum of 2% of the improvements that come from the use of the new technology are coming because the new technology is basically figuring out whether you're black and Hispanic, or Hispanic by looking at the distribution of the attributes. So that seems like good news, but we're still stuck with this problem that there's a distributional consequence associated with it. So what do we learn from this work, which is that, so we try to give you a framework for thinking about these issues. Obviously, there's greater predictive power, there's gains for producers, but there is this increased disparity in outcomes for consumers. We also show you, as it happens, that the distribution of credit scores for black and Hispanic applicants becomes more diffuse. So if you're a black and Hispanic or Hispanic applicant behind the veil of ignorance, you might be worried that your credit score is going to be drawn from a more highly variable distribution. Not just the mean gets affected, but also the variance. And doing the empirical assessment, we suggest that these unequal effects do manifest themselves. So this might be an issue that we should be concerned with. So without further ado, I'll turn it over to Chuck.
Hello, thank you, everybody. I'm happy to be here. Oops, I guess. How do? Okay. Control L. Okay, thanks. Hello, everybody. Thank you. Say that I think some of my conclusions differ from yours. I think they're not necessarily in conflict. I think we look at things a little bit differently, and most of the work that we've done looks at the entire universe and not specifically at mortgage. So it's looking at all products, by which the expectation is that in mortgage, there's more likely to be bias because that's a very high touch product, right? For credit cards, race is basically not a factor except for some of the maybe self-fulfilling cycle that Stefania talked about. But they look at your credit data, you go through an automated system, nobody knows whether you're part of a certain protected class or not. So that part, I think, is essentially blind. But again, as you get to, there's pretty well noted lawsuits in the U.S. Associated with indirect auto lending, for example, by which in the U.S. auto loans are collateralized, and what you have is that the auto dealer is a member of that deal. So basically, the bank's customer is the dealer, not the consumer. So basically, what they have agreements, and they work with the dealers work with the banks, and the banks offer them what they call buy rates. And so what happens is that the banks might say, I approve Chuck Robita for a 5% auto loan. But the dealer looks at that and says, well, I think Chuck will pay 7%. So what they do is they mark that up. I still have the ability to accept or deny that offer, and I can go out and get my own financing, but I think most people probably don't know that. So where the disadvantage comes in for those people who are less educated is that they get a loan that's marked up and they're paying a higher price when in fact it was the dealer intervention that caused that. So a lot of lawsuits against major finance companies where the dealers were marking up those loans and they held the banks responsible as well, even though they're not actually part of that markup. They accept some of the spoils of that. Okay, so I'm going to speak specifically about credit bureau scores. Almost everything we've done to this point is logistic regression. We're launching our first machine learning model very shortly, and I'll touch on that briefly. And also I'll talk a little bit about some trends which I think overlap with Jan and Brian a little bit, but I'll be light on those because I don't want to steal their thunder. Okay, I think we just want to remind myself what FAIR is. I think Stefania did a much better job, so we can just skip over that. So in terms of credit bureau scores, when we look at the Equal Credit Opportunity Act from 1974, one of the key statements in there is statistically sound and empirically derived. Well, that really doesn't insulate anybody from discrimination or lack of fairness. I mean, there's two examples that I like to cite, and the fact that the methods themselves, I believe, are unbiased. They're looking at the data and taking potentially past information and introducing a bias. So one example of that is, these are two huge finance or tech companies in the United States. I won't name them. You can Google them and find out. But one was trying to use information they had from their human resources system to predict the success of an employee, to use that in their hiring decision process. And after they did that, what they found was that it was biased against women. And so, without understanding the specifics of how that was designed, my thought is that probably reflects their current environment in terms of how people succeed and what decisions are being made along the way. And that's just reflecting their current environment. Another one is facial recognition. They've gone through and done studies, and that the misclassification for African Americans is much higher than it is for Caucasians. So here you have data, you have techniques that are unbiased, but that doesn't protect you from a biased system, because the bias is going to be in the data and the design of what you're developing. Okay. So as far as credit bureau scores, we don't know what the ethnicity is. All we have is the credit data itself. And if we look at the most overt case of discrimination, two people walk up with the same score, and the protected class gets declined, and the white Caucasian male gets approved. And so in that situation, the only factor is in fact race, and we're blind to that. So we don't have the information that lender used to bias their decision. Again, something more common is the price that someone will pay, right? We have evidence of that on the bureau. We can make inferences as to what a credit product costs. It's very relatively easy for installment loans, a little more difficult for mortgage, but we have methods for revolving. So theoretically, if we used attributes or summarizations of what people were paying, we could introduce possibly that bias into our scoring systems. We create those, but we use those for marketing to try to market loans and products to people and beat interest rates so they'll accept our offer. So if we use something like that within our solution, we may well end up with a biased solution. So again, we're just looking at credit behavior to predict credit performance. And so, our findings have been is that the data doesn't predict differently for protected classes versus non-protected classes. And we go through, in order to get at the nonlinear situations, what we do is segmentation. So what we try to do is identify peer groups according to risk by which we place people in, and then we build separate scorecards off of those different nodes. So the nodes are mutually exclusive and exhaustive of the population, and you can think of it like a pachinko game. They fall based on that criteria into the individual nodes, and then we score them at those nodes, and due to the properties of logistic regression, we can add those scores back together and, by and large, get the same interpretation of that score. Okay, and we go through, and this is how we improve the performance of our models. And it's quite a bit of a challenge to go and find those pockets where we can actually find where the data does predict differently. There's really no fixed way to do that. It's basically, I have an idea, let's try it, and build a solution and see if it works better. And really what we found to work the best is categorizing people by risk. So again, based on the dependent variable, whether or not somebody's going to default or not, and what's actually worked best for us is actually getting a quick score to categorize them into 4 or 5 risk buckets. And then we can get at things that are more indicative of risk for those peer groups. So for example, number of 90-day rated trades on my credit report. That's going to do a good job of ranking people from lowest risk to highest risk. However, when you get into these now risk subsegments, that'll still probably help you distinguish some of your very low risk, because they might have 1 or 2, but that's going to differentiate them. But everybody in the highest risk group has a derogatory, has a delinquency, so it's no longer a distinguishing factor. So what we have to do is start looking at things, well, what have you done for me recently? Right, so now we can look at not your delinquency ever, we say, what have you done on your accounts in the last 6 months? So that allows us to get at the very unique aspects of these groups to really extract as much information as we can out of the information that we have. So again, that's how we improve the performance of our solution and improve classification. Okay. So some of the machine learning techniques do that for us, but there are risks, and I'll talk about those in a little bit. Okay. So in terms of our testing of credit bureau scores, getting at race, ethnicity, we don't collect that information. Again, we do have some demographic information that we call above the line on the credit report, and that's forbidden to use. We don't use anything that's related to that consumer, their address, sex. There's employment information that's sometimes reported on there, but that's all ignored as part of our solutions. Okay? And so we only actually use the account performance. So we don't know. We only get the data once it's been approved, right? We don't know whether somebody was declined or not. We don't know if they were charged a higher price. We can see what price they were charged, but we don't know if that was higher than somebody in a peer group. I could probably do that, but again, we don't specifically use that information to prevent that from introducing bias. Okay? So we have to there's a couple of methods that we can go and get race. Again, we don't have the HMDA database where it actually is explicitly labeled whether you're in a protected class, and what that protected class is. So there's a couple ways that we've done it. One is based on HUD definitions, based on basically geographic classifications, whether or not you're more than a specific zip code or tract level is 35% of a given ethnic group or race. Okay? So that's one that we've used. We also have a race proxy that's actually in our marketing group in Experian that is used for target marketing. And it's very similar to what the Consumer Financial Protection Bureau has advocated in terms of trying to test this on non-mortgage products. So it's a surname geocoding. So what it does is it uses information in terms of knowing what probability you are of being in a certain ethnic class at a zip code level, and then looking at things like your name to help improve that classification. So the one that we use, I think, the one that the CFPB has advocated is just using the surname. The one that we use actually uses first name because there's some names that are very specific to certain ethnicities that you can decide right away what they are, and then resort to surname if you have to. So for example, if somebody in a certain protected class has married white Caucasian, you'd be able to pull that out because you could potentially identify that by the first name. Okay? So when we do that, we have the couple of methods, and we use both of them. Most recently, the race proxy. And we've looked at it, looking at the interpretation of the score, so essentially what the default rate is, controlling for race and ethnicity. Okay? And by and large, what we see is that those default lines are on top of each other. And again, what's different is that we're not specifically looking at mortgage. We're looking at numerous products. And again, when you look at a consumer's profile, probably 70, 80% of the, probably maybe even 90% of the accounts on there are typically your revolving accounts, like bank cards and retail cards, which again are much less prone to any type of discrimination to begin with. Okay. We've also done regression analysis where we use a score or even individual characteristics, because one of the regulatory agencies has come out and said you can't use these characteristics, they're indicative of protected classes without any research. And we've gone through and we validated things at the attribute level, and we didn't find any specific bias, again, based on an aggregate using the proxy. Okay. So now I just want to talk a little bit about universe expansion. So Stefan, you put up there what the scoring criteria was. That's for our competitor's score. Oh, I won't repeat their name, kind of like Harry Potter. But what VantageScore did was it went and expanded the scoring universe. So it relaxed that 6-month criteria. So theoretically, you could have an account on there for 1 month or 2 months, and still be scored. And you didn't necessarily have to have an update in the last 6 months. It could have been as much as 24 months ago. But that pulled in a lot of people who were, not necessarily credit active or not frequent users of credit. They're likely to be, they may be viewed as somewhat higher risk because they don't have as much information. But it still did a good job of classifying them in the relative risk. So that was really our first foray into the universe expansion. What we've also been using is what we refer to as alternative data, and alternative data can mean just about anything other than credit bureau data. One thing that Experian has launched in the United States is a product called Boost. And so what Boost allows consumers to do is opt in. Stefania has gone through the process. I have to say, as an Experian employee, I haven't done it yet. So that'll hopefully not leave this room. But what it allows you Experian to do is that the consumer opts in and provides access to their checking account or DDA file. And what it does is the technology goes in and grabs information based on certain codes that identify telecom or utility, and it can look at your payment history from your checking account to those types of organizations and actually make that into an account on your credit bureau report. So what that does is that allows thin files or people with impaired credit who have been paying their bills to actually get credit for that. At this point, it hasn't expanded the credit universe like we thought. That there's some constraints in terms of you already have to be on the Experian Bureau to go through the proper validation. So that'll probably be worked through in the future in terms of how we expand that credit universe. And the other, I think, great thing about that is it's kind of a democratization of data, that the consumer actually has control over whether that data is used or not. So what happens is that you can opt in, your score will be recalculated. It's actually the FICO score that Stefania referred to. And based on what that does to your score, you can decide whether to include that data or not. Hypothetically, every time you added positive information, you should get a higher score. However, when I talked about that segmentation we do, sometimes if you jump segments, sometimes your score can actually go down. So that's one of the flaws of that segmentation, or the cost of segmentation to get improved performances. If you change segments, you don't always get a logical movement. But what you can do is you can test that data and decide whether you want that or not. Okay? So in mortgage, that's critical because the FICO score, which we're viewing the change on, is the one that's used in the mortgage decision. For other models, for bank card or auto, there might be custom models, so the consumer may not actually be aware or ever know whether that positively or negatively affected that custom score where the decision was made. But in general, they can look at the predominant score and see whether or not that adds benefit and decide whether to keep that data or pull that back. And again, they can decide that at any point in time. Okay? So again, where we've seen the most benefit in terms of consumers boosting their scores, thin files. We were just talking before the discussion about we're based out of Nottingham, England, and we have people coming from the UK to the US offices, very high-level executives, and they complain how they can't get credit because they don't have a credit file in the US. And they think they've made it once they get the pre-approved offers in the mail saying you have enough credit data for us to view you as being somebody low risk, and we have a little party for them. Okay? So, the problem of getting credit isn't necessarily just limited to minorities. It affects anybody who's new to credit in the United States. But I have to say there is some biases and privilege there. For example, I list my kids as authorized users on my credit cards, thereby giving them a credit profile, and they can benefit from that. So there's a distinct advantage for people who know credit and can use that leverage, right? If you have parents by which they don't have good credit, don't have good role models, et cetera, that can also be, prevent you from using an avenue like that. Okay. We also use public record information, so we're launching a new score, and it looks at a variety of things. Education is one of those. It kind of looks at some fraud metrics in terms of how many times have you been in, have you moved in a certain period of time, how many people are living in a house. These are things we evaluate. I'm not sure they all made it in the final solution, but things that won't be on the credit report that, again, are used in a score to help people go above the cutoff after they've been declined. So really these scores and the use of that data can really only benefit you. Okay? And then there's other sources of data like DDA checking data where you can go in and check NSFs, non-sufficient funds where you bounce checks. But again, that's offered in the US, but Experian doesn't have any solutions that currently uses that. Okay. So in terms of credit data, so again, when we look at modeling, or I look at modeling, there's the macro level and saying how well does this solution rank ordering everybody? But below that are actual people. And you always need to remember when you're doing the models that there are people behind there. So, it's not, you want to try to get as correct as you can at the individual level. And so there was a initiative by the Consumer Financial Protection Bureau called NCAP, National Consumer Assistance Plan, that went through and mandated some updates to the credit bureaus to clean up some of the data they had. And most of that was public records. So for example, you could get tax liens and judgments, but that was biased somewhat by state, and they weren't very responsive to disputes. So that all those were wiped out. And then collections, when you don't have a single payer medical plan, there's a lot of billing issues, and people end up with a lot of collections for medical that they may not know that they had, or it's due to a dispute. And so there was a huge cleansing of that based on criteria to make sure that the information was accurate. Experian actually went above and beyond that to clean out some other things above and beyond what the Protection Bureau had advocated. Okay. Another thing is that the data being reported has more detail, and we've gone through and we've significantly increased the complexity of our attributes, cross-checking different elements to make sure that we're getting the right answer. And what we found is that over the years the complexity has increased, but the performance of the models related to that summarization hasn't increased as much as we thought. But I think what we're doing is getting it, we're not seeing it at the macro level, but I think that enables us to get it right at the individual level. Okay. So again, I think that where we're going as far as methods is machine learned. We've done quite a bit of testing, and we've kind of settled for now on extreme gradient boosted decision trees, and we've observed probably 5% performance over other I think about 5% above and beyond what we would get from a segmented logistical model. Again, it gets rid of that need for segmentation, so those boundaries that we have that you can skip over, we won't get that misclassification because we're working with all those interactions within the 500 or so decision trees that are behind the scenes. Okay. It doesn't make it easier. That, in fact, you can look at a logistic model and you can logically validate it very easy. Nobody looks at 500 decision trees to make sure everything is going in the right direction. So, we had to develop special reports to make sure that everything was interpreted monotonically. That means that, for example, if I have for example, the number of open bank cards is positive, that it's always positive regardless of which branch of the tree it is. And that there are some commercial packages out there that offer it, but it's not really as robust as it should be. So our data scientists actually went in, modified the algorithm to really enforce those constraints such that there was no misclassification based on a spurious trend. Because what we find is that will force what will be an overprediction of what it is on the development sample, but when you go to test it in real life, it doesn't do as well. So overfitting and stability over time is heavily related to making sure that the model is logically valid behind the scenes. Okay. Okay. That's it.
Okay, good evening. So I will give a little bit of view from a European perspective. So I will start a little bit with recent trends, very briefly, because I will try to keep it to 10 minutes. And then in the end, more of the consequence of that in the way on how in ING we do consumer lending. So first, very short, last years in Europe, basically what we see is a lot of competition. I think that's a good thing. We can discuss that later as well. And if you see here, the blue bars is the impact of competition on changing credit standards. This is for the housing loans and quite similar but less outspoken trend for consumer loans. So I think if you think about competition in Europe, it's basically from coming from fintech for sure, and from less traditional banks. So most of the time, digital oriented. We live in Europe, so you also know there's a lot of difference across the different countries. You have here always the top 5 countries: Germany, Spain, Italy, France, and the Netherlands. Of course, quite a different picture depending on which country you live in Europe. So, but I think important to remember there is a lot of competition. I think that's a good thing, and it has impact on pricing, it has impact on credit standards and on terms and conditions like collateral, etc. A second element is regulation. I think quite exciting times, at least for us as being part of the sector, quite exciting times when it comes to the last 2 years, and 2 important regulations which I think highly or will highly impact the way banks, financial institutions, lenders look at credit and approval of credits. So the first one has to do with data privacy. Global Data Protection Regulation came into effect last year, I think 25th or something of May 2018. And basically what it says, and it's not only for financial institutions, it's for all industries, it says that as a consumer, a customer, you have all the rights to be in control of your data. So whether or not an organization in every industry uses that data, it's your right to allow or not allow that. I think when we talk about credit scores and so on, that's quite relevant. It also requires companies to make sure that they're fully in control of data. And historically, we know that has been an issue, I think not only in Europe. There is more regulation, also prudential supervision on how, for example, a financial institution we deal with all this data and so on. For ING, it's quite high on the agenda, so I think we're in a pretty good shape there, but there's still overall as an industry a lot to do. What we do think, however, is that as an organization or a bank in our case, when you might want to make a difference towards your customer, I think your ethical promise, your data promise of what you're going to do with the data and how transparent you are towards your potential customers or real customers will become even more important. And there I think that is another positive evolution when we talk about fairness and consumer lending. The second one, I don't know if you're aware of that one, is PSD2. PSD2 is not an official regulation because it's a directive, as we have a lot of directives in Europe, and it's called Payment Services Directive. Quite an important one, very important one. It is now being translated or actually being implemented by different countries, all countries almost. What it does is twofold. One is making sure that the way we deal with payments is more homogeneous or uniform across Europe. And that is very important because that increases security and more equal treatment across different countries. But the second one, and I think more, and that's the upper part, even more important for what the topic we discussed today, is that it allows what we call registered third-party providers to have access to transactional data of banks. So, meaning as a bank, you are obliged to make that data accessible for other third-party service providers. That is historically not the case. So basically as a bank, you could say like, I have transaction information. I don't need to share that with anybody else. So I can use that for whatever we want to use it for as a bank. But if another third-party service provider want to use that transactional data, they don't have access unless the customer would make a download, probably in a PDF, and send that to that, for example, lender. Now that's gone. I think by September 2019, all national competent authorities, so most of the countries, will have put this new directive into production, into effect. And at that moment, what you will see is that for different services, whether it's account aggregation or whether it's lending, instant lending, that's very relevant for today, you will be able, as a service provider, whether a bank or a non-bank, to use transactional data of customers for the services you want to provide. Bearing in mind the previous topic, of course, only with the necessary consent of you as a consumer. So I think that's two regulations, GDPR, PSD2. Credit bureaus in Europe. I think that's a third part before I go to the implications on consumer lending within ING. It's already briefly mentioned today. It's different failed credit bureaus in Europe compared to the US. First of all, the good news is they do exist in most of the countries. I think it's good news. We see that there is a clear trend that more and more data is available in credit bureaus. And this is all publicly available information. So if you Google ACCIS, you will see the different reports over, they do every 2 years a survey or something. But on the other hand, more is possible and probably necessary when we think about how data can be used for the better of the consumer. Today's situation is that you see actually a couple of European countries and different types of organizations which in that country do or do not supply data to a credit registry. There can be more in one country. Sometimes there is almost no in one country. So what you see is that most of the banks today, they do provide some information. This doesn't tell yet how much information, but some information to those credit registry. Mainly missing part, which there is a lot of attention lately on a more global level, is about utilities and telcos. That's still mainly missing, and a lot of financial institutions strongly believe that that can help the credit scoring area. But as of today, that is not yet the case. A similar picture, but based on product types or product services offered. Here you have another distinction between only negative or negative and positive. So that is really changing rapidly. So until a few years ago, or even 2 or 1 year ago, it was mainly only negative, but now you see it really changing. That also positive information, so not only delinquencies, but also just if everything goes well with, for example, your credit, that data is also shared. Very important here is what is the role of regulators, the role of policymakers and the law. As of today, I think 63% of the cases, it's now required by law to make sharing of data requirement, so it's required by law to share that data. That is up 30% compared to 2015. So that keeps on increasing. And then an element which is not yet improving, that is how the data can be shared cross-border, which I think is an important element, what we will discuss today as well when we talk about fairness, especially when we expect or we see immigration being increasing across European countries from outside or within Europe, but that is still quite an issue, I think, that data is not yet shared. Now, if we put those three areas together and look at how ING looks at consumer lending, so we had basically increased competition, we had new regulation, and we have credit bureaus which we use as input of data, but only in combination with other data and applied to internal models. That was also already during the introduction. Most of the cases we don't use a credit bureau score, but we try to use the credit bureau data wherever available. So first of all, it's more from a traditional financial institution view in terms of competitiveness and what we need to do and want to do. So a clear trend that will be not new for you is that lending should be automated as much as possible. We don't only talk then about the credit approval process, but the whole end-to-end processes, from approval until the moment that the customer will not be a customer of the bank anymore. To do that, we need models. There's a strong intention, and I think ING is considered quite often as one of the more innovative banks in that space to really fully automate the process. Why is that important? I think different elements. So first of all, we talk about customer experience. I think that's clear. You can get instant lending. You don't need to wait a couple of days. You don't need to provide a lot of documents or whatever when you go for a loan application. But secondly, and that is often forgotten or not forgotten, I don't know, but the more we automate, the more efficient we become as a bank. And that's not only good for the bank because of being more profitable, but especially good for the customer because then we can charge lower prices. And thirdly, that is debiasing the decision making. So it's really important, and we see that over and over again. The more we automate, the more accurate we are in having a correct pricing and making sure that we don't get surprises when it comes to defaults or whatever. And a surprise is never good, not for a customer, not for a bank, not for society. I think quite similar to what was discussed in the previous sessions. Maybe one is a little bit not yet touched, is technology, but how do we make sure that our models get better? Because they need to get better. It's data, it's modeling techniques, and it's technology. So a clear trend there, I think, across the world, basically. Experimenting with alternative data. And I say experimenting because we need to experiment with the academical world, within the industry, with whoever wants to participate. We cannot pretend that we know exactly how to do everything, but we have to make sure that we get better in what we do. The same holds for different modeling techniques. We do have a number at ING, which is on average. We have now done quite a lot of those experiments and also already put in production. It's in general 10% increase, purely based on the modeling technique. That doesn't mean what I have learned earlier today, that we solve the issues of fairness, but it does improve or increase the performance of the models, which is also relevant. Personal opinion is that adding alternative data is more powerful than doing or experimenting with new modeling techniques. But of course, the crucial point is to combine both. And especially when we start using more and more data, then we need those techniques. Because we know when we see that we live indeed in a non-linear world. So the pure logistic regression, what we also used to do, doesn't work the way we want. But I also want to touch upon the technology part. I think there it's going very fast, and especially the bigger banks in Europe still have quite a lot to do. Also there, I'm rather proud to work for ING, but being able to do real-time scoring. And remember, when we start approaching data in real time, which is not available at our environment, at our servers. We need to be able to run such a complex machine learning model within a couple of seconds. So technology there is extremely important. It's going very fast. We need to, well, we do have a lot of investment, but it will really help there as well. And I think it has a positive impact on the fairness discussion as well, when we can use alternative data for real-time scoring and making a sound decision. Coming back to the earlier point about PSD2 regulation, I think that is really a crucial one, and that nicely links to the topic tonight. Because basically, if you look at traditional scorecards of banks, and I used to make those myself still 15 years ago or something, and what you see is that social demographic information are actually the most relevant one in a traditional scorecard with limited data. If you have some credit bureau information, it's negative. Of course, that's the most powerful. When it's positive, it doesn't tell that much. We come back to social demographic information. I think that when you use so much social demographic information, of course, banks do not explicitly use coefficients or drivers which are perceived to be discriminating. That is very well understood. It's very well regulated as well. But I do fully agree that implicitly it has the same effect. And I forgot the name you used. I should remember that, but that's one of those three unfairnesses in the algorithm part, which happens in reality. What we do see is the moment we start incorporating transactional information, can call it behavioral, but I call it here transactional information, which means the way how you use your daily banking products. Not credits, but really your saving account, your current account, sometimes your credit cards. Basically, it starts ruling out the social demographic drivers as relevant for your final scorecard, for your final model. And I think that's quite crucial. And if we go further, well, we do the experiments, but we're not yet happy. But with, for example, more data which is available on your mobile device, like I have seen examples of, it's not in Europe, of I think it's somewhere in Asia, about using the Google Maps data to see if you really go every day to work, because then probably you have a job and you don't have issues in trying to define those kinds of things. But and the same holds, of course, for other things you do on the internet. It's a well-researched element, but for us, transactional data is a big differentiator here, especially with the PSD2 regulation. It will reduce socio-demographic information in the final scorecards, and I think it can have quite a positive impact on the way we deal with fairness in the financial industry. And let me end with one use case. It's quite straightforward. What we do is, I link it to the transactional information, is how can we land in only a couple of minutes to a completely new to bank customer. And I think with the current technology, the more data which is available, we can do that. And I think it's for the better of the customers because of ultimately better models, better discriminative power of those models, but also less potential discrimination. And I have to say to that topic that I think there is room, there is for sure room to put this topic more into attention in Europe. From my personal experience, I was researching a little bit before I came tonight to this conference, which also already gives a little bit indication that it's not always high on the agenda of regulators or supervisors. And I think that's probably, I don't know, I never worked in the US, quite different compared to the US. But I'm happy to discuss that more later tonight. Thanks.
Thank you. I'm very pleased to have a chance to be part of the discussion here tonight. There I am. And I've already learned from listening to all of these talks. Let's start with one small disclaimer. As you can see, in fact, these slides are preliminary. They didn't make their way through the full clearance process, internal review process at the CFPB before I had to leave. So I don't expect there to be any substantive changes, but watch for the final slides to be posted later. My goal for the next 12 to 15 minutes is to talk to you a little bit more about the context of the United States, about the fair lending regulations, at least one important fair lending regulation, and how it's enforced in the US. Talking a little bit more about the unscored and unscorable population in the US, and finally wrap up with some indications to where government agencies are beginning to think about alternative data and machine learning. Guess that didn't. Before then, though, I need to do the non-standard disclaimer, which goes beyond the standard disclaimer to just say that though I'm here representing the Consumer Financial Protection Bureau, what I'm about to say is not legal advice, interpretation, or guidance. Anything I say is my view and not necessarily those of the CFPB. So there are several fair lending laws in the United States, and their enforcement is shared and divided across many regulators. One of the key fair lending laws is the Equal Credit Opportunity Act, or ECOA. And I should note, by the way, there's another provision over which the CFPB has enforcement authority, which is the unfairness provision, or prohibition on unfairness, which governs unfairness in unfair acts and practices. Here I'm just going to focus on fair lending because I think that's really what tonight's conversation is focused on. ECOA is one of the primary fair lending laws in the US and one that the CFPB enforces along with other agencies. It prohibits discrimination in any aspect of the credit transaction based on race, color, religion, national origin, sex, marital status, and in many cases age. So there's some caveats on the use of age, including you need to be old enough to enter into a contract. Maybe not as well known is that it also bans discrimination against people receiving income from any public assistance program, and discriminate against people who have exercised in good faith their rights under consumer protection laws, like disputing a bill. The ECOA Act is fairly broadly applicable, covering mortgages, auto loans, student loans, loan servicing practices. Some of the other fair lending laws are a little more specific to certain products. And under ECOA, redlining is also a prohibited practice under ECOA. That is, as I think Stefania alluded to, when people living in a certain area or neighborhood are not given the same access to credit or terms of credit as people in other areas because of the composition of their neighborhood, the race, color, or some other prohibited reason. The CFPB goes about enforcing and supervising ECOA in the first line by regularly reviewing the institutions we supervise for risks of ECOA violations, along with many other types of exams that the CFPB does. This involves starting with first looking at the fair lending history. Have there been past fair lending violations at the institution, and looking at their own compliance management system. So the training, the processes, procedures, and oversight in place within the institution to make sure that they're complying with the rules. The exams also look at how institutions market and advertise their products and to whom, and what their policies are on accepting applications and referring applications, say referring them to an affiliate or a subsidiary or to a certain type of product. And then, as might be expected, looking at the lending decision, underwriting, pricing, servicing, and redlining as well. And the role of models in several of these stages, and automated decisions, including the institution's own validation, internal validation or testing for fair lending risks, to make sure that we understand how that's being done and how frequently, for example. The Bureau also does more targeted ECOA exams. They tend to be focused on a single product, like, say, mortgage servicing or student loan originations, where there appears to be some heightened fair lending risk. Those typically include a statistical analysis, and that's when some of my colleagues who are PhD economists, like myself, but some of my colleagues will go in and do the econometric analysis underlying those analyses. And the CFPB also takes enforcement actions against institutions when necessary under ACOA. So that was the background on the U.S. fair lending laws and or at least ACOA, and how the Bureau approaches enforcing and supervising institutions for ACOA purposes. Now I want to give you a little bit more context on the situation in the U.S. in terms of who is scorable, these unscored consumers that Stefania mentioned, and who's likely to have some trouble getting access to credit, and who may potentially benefit from alternative data because they're currently don't have a credit record, or they have a credit record but they're unscored for one reason or another. To get at this, some colleagues of mine at the Bureau took the consumer credit panel we have and matched it to some census data. Now, the consumer credit panel at the CFPB is a 1 in 48 sample of de-identified credit records. We have a 1 in 48 sample of credit records. We do have birth year, so we can tell, we can analyze things by age, and census tract. And it's that census tract that these colleagues use to match to various tract level data, and to understand things like how many consumers are unscored within each tract, and how that varies by demographic characteristics of individuals in those tracts. Overall, they estimate that 11% of adults, in this case people 18 or over, don't have a credit record, who they deem invisibles. And an additional 8% of adults lack a credit score. They have a credit record, but there's not enough information or not enough recent information to score that file. But that 11% net and 8% differ sharply across groups. Here I show you differences in the invisible rate, which is the dark green bar, and the unscored rate, extending at the lighter green bar, by race ethnicity on the left, and by income, tract level income on the right. So you can see, for example, whites, 9% of consumers were estimated to be invisible, and 7% unscored, compared to 11% and 8% overall, whereas we have much higher rates of unscored populations for Hispanics and blacks, and likewise higher rates of unscored and invisible for Hispanics and blacks. And you see even steeper gradient in the share that are unscorable or invisible by income. Going over 40% of consumers in low-income tracts. Those are tracts where the income is the median income in that tract is 50% or less of the median income for other tracts in that metropolitan area or county. So these are the lowest income tracts. You can see that consumers in those tracts, approaching half of consumers, are either unscored or have no credit record at all. Now, one idea that has gotten recent attention is the role of the geography of financial institutions, particularly traditional financial services, and whether that can help explain who has a credit record and their use of credit. Now, the idea that a shortage of nearby financial institutions might inhibit consumers' ability to establish credit is one that on the surface maybe makes sense. I show here in this picture the fraction of consumers, now this is 25 and older, the fraction of adults 25 and older who are invisible by whether or not they live in a rural area, a micropolitan area. Those are areas with a city of about 10 to 50,000, no bigger than 50,000, or in the bottom two groups, in a larger metropolitan area. And you can see that in rural areas, about 15% of people aged 25 or older are credit invisible. They don't have a credit record. And that's compared to less than 10% in metropolitan areas. But in fact, when my colleagues match these data to data we have on bank branch locations for banks in the US, it turns out there's very little relationship, systematic relationship between credit visibility and the distance to the nearest branch. But the research paper they did offer up at the tail end one intriguing finding that should not be taken as with any causal interpretation, in part because you'd want to probably dig into this deeper and control for more things. But in contrast to the finding that there's very little relationship between credit visibility and distance to a traditional financial service institution's branches, there's a stark relationship between credit visibility and availability of high-speed internet access in the tract. So what we have here is a chart that shows the fraction invisible on the y-axis, with separate lines for the consumers in the low and moderate income groups, the low and moderate income tracts, the middle income tracts, and the upper income tracts, the highest income tracts there. Plotted against on the x-axis, the estimated share of from Federal Communications Commission data, the estimated share of households that have access to, who could have access to high-speed internet. And you could see that as internet access to high-speed internet increases, the share of invisibility drops dramatically. So again, I wouldn't put a causal interpretation on this, but it's quite intriguing, the idea that perhaps the ability to access your lender online helps to maybe improve visibility. Now let me wrap up just by offering some illustration of where US agencies are in terms of their thinking on alternative data and modeling approaches. These agencies are aware of the potential benefits and risks that are out there. They've stated that, and for example, the CFPB in February of 2017 put out a request for information on alternative data and modeling techniques in the credit process to try to understand where this market was, where it might be headed, and some of these costs, potential costs and benefits and risks to consumers. And in September of 2017, we issued a no-action letter to Upstart Network. Now, a no-action letter is something that a company can apply for from the CFPB. If they have a product that is innovative and potentially seems like it could have significant benefits for consumers, but there's regulatory uncertainty as to how it might be treated under certain provisions, including fair lending rules. They apply for a no-action letter and receive one subject to limits and conditions. The CFPB indicates that they have no intent to initiate a enforcement or supervisory action against that institution for that product as specifically described in the no action letter. In this case, what it was Upstart Networks complements their traditional credit scoring model with information on employment history and education. And stipulations of the no action letter include a lot of sharing data and information. Then Upstart will be sharing a lot of information with the Bureau about their applications, the outcomes, the testing that they're doing for fair lending concerns and that, so that the agency can see how these alternative data are affecting outcomes. We can see how they actually work in the real world and understand both the benefits and the potential risks of alternative data. Other agencies have been talking about this as well in the US. In fact, the Government Accountability Agency suggested that many of the financial regulators clarify lenders' use of alternative data and how lenders should think about alternative data. But that report is one that gives a nice summary, I think, of the perceived risks and benefits to consumers, including increasing access to credit, potentially faster decisions and what have you, but also the risks of alternative data. And the Federal Reserve System has a very nice piece that came out in their newsletter in 2017 called Keeping FinTech Fair, thinking about fair lending and UDAP risks, that I think also provides a very nice summary of some thinking on that. So, thank you.
Discussion, and I would encourage the audience to prepare questions because I would like to get a few questions from the audience as well. So, Brian, if you want to stay up here. So to start the panel discussion off, I'm going to start with a question which is very broad, which is the following. And this is going to be the only question, and then I'm expecting some audience questions since we are running a little bit late. So in all our presentations at some level, there was a tension between socioeconomic data, which includes some of the protected categories that we're not allowed to use in the United States in our credit scoring model and our allocation decisions, as opposed to transaction data. And what I thought was really interesting coming out from Jan's presentation as well is that in the United States, we've had access to quite rich transaction data and now potentially even richer transaction data coming from, for example, the Upstart type initiative or the Boost type products. Whereas in Europe, until more recently, there was more, reliance on socioeconomic data, which might include some of the attributes that in the United States are protective, and now, we're getting access to more transaction data. And sort of based on the US model, I think there is this strong sense that it is important not to use some of the socioeconomic data, including, for example, race, because this has been, one of the main topics of discussion, to prevent, discrimination and fairness. But on the question that I have had sort of looking at the literature, both in economics and in computer science, that deals with these issues, is the following. If we could access that information, couldn't our models be fairer in the following sense? On the one hand, we could possibly correct some historical bias in the transaction data that we see because that is influenced by heritages of exclusion. And on the other hand, we struggle to assess fairness of our approaches or models because we can often use only proxies for, the categories that we're trying to target, whether, say, different types of minorities have differential access or face differential conditions. If we had that data, wouldn't it be simpler to really assess fairness? And so is this anti-classification idea, that's the, the computer science name for not using these protected categories, really the necessary condition for, guaranteeing fairness? Or could we actually make more progress if we, in a supervised way, we were allowed to use that information, both to, develop models and to then test models from the fairness perspective. So this tension between socioeconomic or protected category data and transaction data, how are we going to resolve it going forward? Especially given what Tarun showed us, that essentially, with better technologies, we might be able to some degree triangulate that information anyway, and technically that is illegal in the current system, so we all understand that, and it's illegal for a reason. But the question is, from a regulatory perspective and a normative perspective at the model development stage, might not we make more progress if we could actually use that information? So this is sort of like a theme question that I would like us to discuss, and then I would like to open to the audience for any questions that they might have. I don't know who wants to start. Chuck, I'm putting you in the hot spot.
I'm going to pass the buck. I'm a consumer of the data.
Yeah.
I don't get involved in regulation. I follow the regulations, so I really can't speak for Experian.
No, but in the sense of, when we use these proxies, to assess fairness, they are proxies, right? Correct?
Correct. Personally, I would be afraid that it would be misused, and not maybe in an intentional way, right? Because now you get into these relationships and it's mitigating other relationships, and you have to be very, very vigilant in terms of understanding what it's doing. And layer on top of that machine learning, where it's difficult to understand what exactly is happening behind the scenes anyway, I think there's a significant risk in terms of combining.
On the other hand, the machine learning literature has shown, there have been some papers that have looked at this specifically and have demonstrated or shown, with smaller data sets, so not the universe of data that credit bureau would have access to, or even the large sample of credit bureau data that CFPB has access to, that actually using this information at the training stage, not obviously at the decision stage, might help both the predictive power of the model, but also may help avoid things like calibration and have better prediction outcomes for the model. So we do have that evidence, from the technical literature, and the question is, what are we going to do with it, given this concern for, fairness ultimately in the credit outcomes, which of course, when you develop the model, you don't directly control, because as you pointed out, you develop the score, and then the score is used by lenders in a variety of ways that may or may not, be legal or fair or compliant with economically what we think about it. Jan, do you have any comments on this, given the evolution of the rapid evolution of the situation in Europe?
No, but I think for me, it's a very easy answer. Yes, we would all benefit from it.
Yeah.
I think we don't have to make it more difficult than that. What can go wrong, it's another thing. And then you need, of course, proper supervision, and you need proper controls and everything else. But that's like with every theoretical problem, because this is a theoretical problem which becomes reality. You need to have the data and the techniques to try to solve it. And as long as you're dependent on proxies, you will likely not solve the problem. Mm. So for me, it's very easy.
Could I jump in here?
Yes, absolutely.
So, obviously economics tells you that the first welfare theorem, should apply, which is that you should go for the maximally unconstrained efficient solution and then redistribute, right? That's, and that's what you should be doing in this particular case if you were to look at the theoretical optimum solution. I think the problem is that the political economy of that is horrible. It's going to be very, very difficult for us to do anything along those lines, which is to sort of just see everything, come up with the unconstrained efficient solution, and then the resulting fight for who gets what and where you start to redress historical inequalities, what you do in order to address differences in distributions, where do you draw the line? These are complicated arguments, and I'd love to hear what Brian has to think about this from a CFPB perspective.
I think I share some of Chuck's sentiments, and I'm actually reminded of your presentation where you raised the possibility that historical biases is just one source of why you may be improving predictive power, but the problem may be more complicated than it appears. I would also point out that one challenge we face, I think, is what data are universally available. And if you're assuming that that we could get this additional information for all consumers, then I think that's a nice ideal. I think the reality is that in many cases, the new data we're talking about are available for only subsets of consumers. So those are my first couple of thoughts there. I guess I'll add one more, which is on fairness. You and I have talked a little bit about Aaron Roth's work in this area and fair algorithms there, where it appears that the criterion for fairness that you use is a very important choice. And so I think it would be a broader discussion that considers what data would be nearly universally available. What do those underlying correlations represent, as you pointed out in your talk? And how do we measure fairness? I think there has been good work in computer science and elsewhere on developing fair algorithms, and very interesting thinking about how to measure that. But my conclusion right now is still that depending on the measure of fairness you use, you could come up with different outcomes and different algorithms.
If I just to react to one of the things you said, because I think it's very important, it depends on each person, of course, which data is available. If you talk about mobile data, do they have a mobile or not, for example? I think it's a very relevant point you make, but there also, as whether it's a credit bureau or whether it's a financial institution, you can solve that problem. So you see now a lot of focus going towards applying different credit strategies based on the data which is available, the data points you have. So exactly, and I think I'm not from a university in this topic, although I did study mathematics, but too long ago. I don't know if it's theoretically sound, but it looks like it can solve already a lot of things.
Yeah, so I think we've fallen into this, always this question of potentially traps, right? So we have some outcomes that, can be self-enforcing. Not having credit means you don't have records, and therefore you may not be scored, and so it's hard for you to get credit. And similarly, so this idea of potentially using different types of information for different customers, depending on what their experience has been, I think it definitely goes in the direction of broadening, the set of information that is used and making it specific to customers. So even the targeting of young files that Experian and other credit bureaus are doing, I think goes in that direction. Because the young obviously have short credit history, it doesn't mean that they necessarily have high default risk. And potentially the young are very good credit risk because they have upward sloping income profiles, as opposed to older borrowers. So this using differential information for different categories of borrowers potentially, it seems like a good strategy. But then why is the information different across these categories of borrowers? And there's a risk of falling again in sort of separating borrowers into classing and then sort of isolating them in a particular, equilibrium or situation. So this seems like a tension that we are not going to be able to get rid of, even if we get more data. And it seems like, though we are tending towards, automated decisions and fast decisions, I wonder, how much we can just leave it to algorithms to make these decisions, in the sense that we have this potential for these traps or self-confirming type notions, even with more access to data and allowing for different types of data to inform us. So I don't know if you have any comments with respect to that, Jan or Chuck or Ryan.
Yeah, I can try. I think one of the things that first comes to my mind is quite interesting. I don't know how it is in the US, but when we talk about credit decisioning models, in Europe we often talk about non-regulatory models, which I think ties very much into the question that you pose, because how do you make sure that we do the necessary testing, the necessary validation, cross-validation, testing over time, because a model, especially these type of models, they are so subject to the environment, to the products, to the macroeconomic environment, to changing people behavior. It goes very fast. We see that and a misclassification, as you describe it, it can not be available in your training data set, but it can pop up from one day to the other. So we need to make sure that banks have it, and bureaus and other lenders, they do continuously look at those models to try to find out, because it will happen. We know that it happens. It's the whole topic of tonight. And I think there, I come back to the point that I think that's mainly only for Europe, I don't know US, but we need more supervision to make sure that it happens. You can, of course, as a bank, you have your own responsibility, so we do that for sure. But I think there, as a supervisor, I think there is also an important role to make sure that the necessary validations, continuous monitoring takes place.
And so you, and this is the last question that I will ask, and then I will open up to the audience. So, Jan, you stressed the role of competition in Europe as a key driver of, adopting better technologies and reducing prices and sort of increasing the number of products that are available. And so in the US there is also competition, but for example, for credit card products, it's a well-established fact in the academic literature that interest rates on credit cards are completely non-responsive to changes in macro conditions, and they just depend on the category of borrower. And the idea is that once you are, you have a particular credit card, if you want to have more credit, you're sort of stuck because there is a holdout problem with a particular credit card lender. And if you try to get more credit, you would have to put in inquiries, which tend to reduce your credit score and so on. And so though there are many credit card lenders, de facto there isn't much competition because each customer is captive, to their, financial institution that they're already, dealing with. So with respect to that, often as economists, we think that competition is great and it can replace to some degree supervision and regulation because, competition gives an incentive to serve customers better. So it seems like the evidence you presented us for Europe seems to be working in that direction. I'm not sure that whether, in the United States, especially for certain types of product, we see that working as well. So I don't know if Chuck or Brian or Tarun have any comments along these lines.
I guess my perspective is that it's not that you talked about inquiries impairing a score, but if I go to apply for a credit product today, that inquiry isn't counted against me, so it's not until future. Right. So if I go to apply for a bank card today, that inquiry doesn't count against me, so that shouldn't be any impairment to getting.
Right now, yeah, but
right.
Eventually it will appear,
right.
And when it does appear, and actually that's I think one of the properties of credit scoring models that is better understood, I think, in the general population, that if you apply for credit a lot, it will eventually, reduce your credit score.
But it takes an immense amount of inquiries to really do that, because what's happened, and Congress has initiated some of this, is that there's a duplication of inquiries. So for example, within a month period, if I go out and shop for an auto loan 4 times, that's counted as one inquiry.
Mm-hmm.
Right? If I go on a mortgage and I'm price shopping within a 1 month period, that's one inquiry. So to rack up significant inquiries, you have to really be out there greedily hunting products to really negatively impact your score.
Yeah, but with credit cards specifically, there's also the issue of credit utilization, which is that if you have high credit utilization, that's a sign that you have high credit demand, and you might, be, looking for other credit card, products. But then, that is going to, be expensive, and so it sort of generates this sort of stickiness of interest rates because of that problem, in addition to the inquiries. And I agree that the complication certainly helps along those lines. So maybe this is a question for Brian, if he can speak to this, but how does the Bureau, or just in general, does the US legislation view the role of competition in sort of, guaranteeing maybe fairness and equal access and conditions for everybody, as opposed to, just the laws that we have that rely a lot on, sort of not using protected categories. How does the Bureau see that component of the environment?
Well, particularly in the context of fair lending and protected classes, I can't speak to that question. Certainly, it's in our statute to make sure that markets are open, fair, and competitive. But I can't speak to the specifics of your question.
Okay. Tarun, anything to add on this?
I guess the one thing I'd say is that if you get process improvements that are not symmetrically distributed across lenders, because some lenders are more rapidly deploying technology than others, then you get some positive selection to those lenders. And then essentially what you get is, even though process efficiency may spread through the industry, this is a different kind of inequality, which is that you get potentially the smartest borrowers, the richest borrowers, getting the quickest and most efficient processing of their credit applications or credit dispersal and pricing, whereas those who are from minorities or lower income will also get hit by this adversely. So I don't necessarily think that process efficiency, unless it's uniform, which I think is very rare, is necessarily something that we should again view as with a technological evangelism type of lens. It may increase inequality in just the same way that we think that it could reduce it.
Okay. Any questions from the audience? Yes.
Yvonne McCarthy from Central Bank of Ireland. I just want to say, first of all, thank you very much. Thoroughly enjoyed the discussion, really very enthusiastic about it. I have two questions. One relates to the issue of the innovation in including more data in the calculation of credit scores. I think it sounds like a fantastic idea, but I just wonder, is there any assessment of ex post how much data is the right amount for a PD model? And I know, Chuck, you alluded to the ability of consumers to add their own data, allow their own data on consumption patterns, essentially with utilities and the like. But my concern with that is that people who are bad money managers might actually just spend too much money on certain categories of consumption. So that could be an adverse thing for their PD, whereas if I understood you correctly, it sounded like it was a positive thing. So that's one aspect. I'd love to see some ex post analysis, which I think we could do because there's lots of surveys out there at a household level which track consumption and PDs let's say defaults on various credit products. So I would love to see some work in that. But secondly, one thread or theme throughout all of the discussions today, which jumped to my mind, was very much about how digitalization in a consumer world affects equality and access to credit. We know we're moving more to a digitalized world, and what we talked about today in terms of adding extra data and allowing consumers to do that themselves, I would see as being predominantly, disproportionately weighed towards people who have the ability and the digital literacy to do that. So I'm just curious to hear the panel's views on that and how that would affect financial issues. Thank you.
I guess I'll jump in and make one statement here is that I believe it's a CFPB that's enforced affordability, right? So now bank card issuers need to collect income, often it's self-reported, to make sure that people can afford their products. So that's another layer on top of it. But if I look at the credit utilization and people being constrained, if somebody is bumping up against their credit limits month after month, that means they're likely not paying down the balances or not using it correctly. That's where you start, I think, getting correlations with the affordability piece.
Mm-hmm.
So in terms of, how do we protect consumers from themselves is kind of what you're asking, and I don't know that there's an answer for that. I mean, we're trying to. You asked there are affordability issues when you go to a mortgage. They try to make sure that your debt to income is within certain guidelines. But I could apply for a mortgage today. My debt to income changes, and then I decide, well, geez, I'm going to go out and buy a new car right after. There's no checks in place to say that once you bought a mortgage, that the mortgage company can restrict you from getting something else because it's going to affect your affordability on that mortgage.
Mm-hmm.
Yeah, I think the topic, the last one about digitization, I think is an extremely fair remark and a very important topic. So I fully recognize what you say, first of all, as I don't have the solution. I think if you think a little bit broader, because for an example, I also worked for a couple of years in Thailand, and I think there we have, for example, the issue of a cash-based society, right? So that's a big issue for banks. If you don't see even the revenue or the income or whatever flowing over the accounts, what can you still do? So as a bank, you start having really problems there as well to make proper decisions, which ultimately also is a responsibility in terms of affordability and so on. So I think digitization is a very important topic. I think it needs to be supported, incentivized. That's exactly where industry has to work together with policymakers to make sure that we get a real digital footprint, and then it's up to the consumer to allow or not allow to use that data. And I think that's the way to go, but it will not be that easy because there is a hurdle. And most of the time, the hurdle is actually having access to sufficient money, and then we get in this in this spiral which we have to solve.
Right. You're passing. Okay.
No, I think this digital footprint stuff is super interesting, but I worry that we haven't thought through the issues of selection carefully enough in this area, which is that the people who are much more likely to want to give you their digital footprints are the ones that have good digital footprints. So then there's a massive censoring issue there. So I don't know how and whether people have thought about solving that carefully. And that's going to be a huge problem, because otherwise you'll just get unraveling.
And also, Chuck alluded to the issue of, helping, preventing the consumer from hurting themselves. So one thing that's probably beneficial to everyone is sort of increased financial literacy in this dimension, right? So very early on in schools, in high schools, and then, in colleges, and just more broadly with, public policy programs, but even I think, financial institutions potentially have a huge incentive to improve financial literacy because it enables them, to actually better assess the decision of their customers, whether, somebody is doing something because they understand what they're doing and they're maybe perhaps doing something fraudulent, or whether they're doing something not understanding what they're doing and what the consequences of that are. So it seems like financial literacy is something that we can, uncontroversially try to promote as something that would benefit everybody in the industry.
I mean, I think if you could get there, that would be the solution, right? Because when people understand they have choices, they won't accept high price offers that get them in that loop, right? That they can manage that better. On my, I just took an Uber recently, and the woman had she was quitting her job, or she quit her job, and she was going to have her own business, but well-educated, had worked at a 9-to-5 job for 20 years, and she told we started talking about credit. She goes, "Well, how can I get my credit score higher?" And I don't want to get into all her details, but that so how do you use your credit? And she was under the impression that it's good to keep balances on your credit cards, and I don't know where that comes from. And so I said, well, you definitely don't want to do that. That's the most expensive cost of money that you can have. And I stepped back and said, I'm not your financial planner. Don't gut your savings to pay off all your bills, but you need to balance that, because that's just not a good practice. So here's somebody who's very well educated, was actually a member of one of the credit sites. It was, I think, through her bank, but had access to education and still didn't understand.
Yeah.
So.
Any other questions from the audience? Yes.
I'm Jesse Leary. I'm from the UK Financial Conduct Authority, and I have a question that I'd be curious to hear everyone's views on. So Chuck made reference to the lawsuits in the US a while ago involving auto dealers that were price discriminating on the financing based on their perception of the borrower's willingness to pay. And you also mentioned that you have price data in the CRA data. And so using that data, using other sources, there's certainly the potential to use data to make predictions about people's willingness to pay for credit and sort of replicate what those auto dealers are doing in a face-to-face setting. And so curious to hear people's views on that aspect of fairness, where the offers are it's not based on default probabilities, it's based on the perception of the individual's demand for credit and willingness to pay.
Who wants to start?
Well, for better or worse, I think there are people in the market that are looking at it that way, such that, price elasticities for certain products are the people who are more elastic in terms of what they'll accept than others. So, I mean, I think that's a new layer of complexity that'll be added on top of lack of education in terms of, what does that play in terms of people's understanding of, what they're willing to accept and what they're not willing to accept. We go to risk, kind of pricing, customer-specific pricing. I mean, you look at the airlines. I mean, that changes constantly, and if they see that you're hanging around, you might get charged a higher price. I mean, there's just all kinds of things. So, I mean, I think it's going to come. I don't know what it's going to look like and how that is going to affect discrimination and these perpetual loops.
Yeah.
Yeah, it's a also very interesting topic. So that's if I boil it down, I don't know if I fully understood your question to, let's say, risk-based pricing. Let's interpret that now in that way. Then there are two ways of a bank of dealing with that. You can start charging premiums, or you can start giving discounts. Well, and the third way is you don't do anything. Yeah. So I don't believe personally in charging premiums, and it already mentioned earlier today. It economically, you would think it makes sense because it needs to be priced in the risk that you take as a bank. On the other hand, you further increase the debt burden, right? So that's of course the problem here. I think when you more look at it from giving discounts, I think it's less of an issue, which means that you are more going to price below market standards. But okay, that's maybe a too commercial view from my part. I don't know, but that's how I personally look at it. That doesn't mean that ING does it always that way. I think another element is, of course, more from product characteristics. I think there is sufficient room to have impact in a positive way on customers, which you perceive as higher risk, and that's what I do see happening. For example, you play with the term of the loan or whatever you have to do. There are different product characteristics, product innovation as well, where you can still find the right balance between pricing and risk that you take for customers which are perceived to be higher risk.
Right.
Well, certainly, we see lenders offering multiple contracts to a borrower and learning through that method themselves, right? So in terms of the lender's assessment of risk and the borrower's assessment of their own risk, we observe that. I feel like I'm missing your question, though.
So setting aside risk, you might have two people who you perceive as presenting the same risk of default. You might have people who present the same risk of default, but you think one of them's savvy, they're shopping, they're not. I can't charge them more than X, or this other person, I think they're going to take whatever I give them, or up to some.
Right.
And so, and loan officers, in a context where they can capture some of those rents, have in face-to-face transactions. There's a long history of them trying to do that. Everything's moving online. There's greater data, better predictability. You can predict willingness to pay.
Could come back with a counteroffer.
What's that?
A loan officer can come back with a counteroffer.
I mean, in a context where you're shopping online and you're offered a credit card at 18%, or someone else who shops more aggressively is offered 12%, or who looks in some way like they're more savvy is offered 12%.
Fair enough.
So if I could jump in here. So I think this is a super interesting question. I mean, I think there's sort of two aspects to this. The first is, I don't know how the elasticity of demand for credit forecasts default probabilities controlling for all other known observable things that we know that control, that forecast default probabilities. I think I can guess. And if my guess is correct, then we wouldn't want to see, sort of first, second, third degree price discrimination in this world. Second thing that I don't know about, which is, again, how does the price elasticity of demand for credit vary with household characteristics, in particular income and wealth? And again, I think I know the answer to that question. So from both of those sort of perspectives, I would worry. But then again, if I sort of restrict the price of credit to be fixed in some way, or invariant to price elasticity of demand for credit, then I'm implicitly imposing a negative subsidy on certain classes of people. So I think there's some very complicated issues here. I think this is a great question. I think this is something we need more work on.
And definitely having access to more data, I think, allows more possibility in terms of targeting people based on, the perceived elasticity of demand. Because the more we know about them, the more we can actually, infer potentially their behavior. So we have way more signals to really estimate that elasticity. Right. So this is really falls into this. Any other questions? Does anybody want to conclude with a comment or something that we haven't touched upon? No?
I think I've spoken enough.
You've spoken enough. Okay, so then I would really like to thank our panelists and Tarun for joining us for this discussion, and to the audience for contributing, and thank you so much.